What is going on, guys? Nick here, back with another video. So we've just passed about a year of me making stock analysis videos, and I thought now would be a good time to go back and look at my first 8 videos and see just how accurate I was. One of the main reasons that I make these videos is because I honestly don't think that it's that hard for anybody to learn how to value a business. All it really takes is a little time learning how to do it. So I have a pretty simplified method, especially when you compare me to a lot of the discount cash flow guys, or the EBITDA to enterprise value, or any of the countless other methods. But I think you guys are going to be pretty surprised seeing how I did just correlating a growth rate to a PE value. I really think that if you want to find out who's worth listening to, that you should go back in time and look at some of their old predictions and see just how well they panned out. Unfortunately, there are a lot of fluff artists on YouTube who will give you really high price targets that I think the stock has probably no chance of ever hitting, and to me that's the exact opposite of anything that I ever want to do on this channel. So we're going to rate my old videos like this: accurate, which is when the price is close to what I expected; overestimated, meaning the price did worse than I expected; or missed opportunity or outperformed, which means the stock did better than I expected. Now we're going to get to the video next, but before I do that, I do want to say that all of these valuations are set with a buy and hold mindset. I'm basically trying to estimate what I think the stock is going to be worth in the future based off of the underlying financials and the business. Value does have a big impact on the stock price, and generally over time the stock price will match value, but price and value are not the same thing, so don't get the two of those confused. So to start this off, I'm going to start out with my first video on Amazon that I did on June 29th of 2020. So in this video, I ended up using a PE of 87 for my fair valuation. The trailing earnings per share was $20.93 per share, which put the valuation at $1,847 versus the share price at the time, which was $2,692. When we looked at the forward valuation, they were projected to earn $37.56 by the end of 2021, which brought the valuation up to $3,267. When I look at this on a chart, I think that my forward valuation was pretty close to the current price. Right now it's sitting around $3,300 after it was in the $3,700 range. So I am going to rate this forward valuation as accurate, but I do want to point out that I think that Amazon is trading at a PE much lower than what I think the company is worth. So if we are only looking at the PE, we would say that Amazon did underperform. I actually made an update on Amazon not too long ago, so if you're interested, make sure you go check it out. The next was all 3 cruise lines on July 3rd of 2020. My opinion on Carnival, Royal Caribbean, and Norwegian was that they were all cheap in comparison to how much they earned in 2019, but they were taking on huge losses. I thought there was a ton of upside, but personally I was avoiding buying them at the time. Things around the pandemic were starting to get a little worse at the time, and I was concerned about how much more debt the cruise lines would have to take on. Initially, when the stock market had crashed, I had bought Carnival and Royal Caribbean, but I ended up selling after only a 10% gain because I thought there was still too much uncertainty. And when I made the video, Carnival was trading around $15 at the time, and today it's sitting at $22, which is about a 46% gain. Royal Caribbean was trading at $48, and now it's at $73, which is a 50% gain, and Norwegian was trading at $15.50 and is now at $22.60, which is about a 45% gain. So I would rate all of these as an outperform. Although I knew there was a ton of upside, I personally at the time just wasn't interested in taking on the risk. So the next video I did was on Facebook on July 11th of 2020. I came up with a fair PE value of 38. The trailing earnings put the valuation at $221 per share, which was a little higher than the share price at the time. Using the 2021 earnings per share that analysts were forecasting at the time, I came up with an end of 2021 valuation of $370 per share. Facebook is currently trading at about where I said they would be worth by the end of the year, so I would say that I was accurate. However, Facebook is trading below the 38 PE ratio that I thought the company was worth at the time. Right now it's actually only at 27. Okay, so this one actually pains me the most. After I put out my video on NEO on July 19th of 2020, I was still getting roasted in the comments months after. The share price at the time I made the video was only about $11, and to be perfectly honest, I really thought this was just a pump and dump. The finances were not good at the time, and everybody was just saying to not worry, that the Chinese government would just keep loaning them money. My concern was, what if the Chinese government took a different position, which they sometimes do? It seemed to me that the underlying financials wouldn't support the business, even if they were selling a ton of cars. Now, since I made the video, the balance sheet does look a whole lot better. They've gotten out of their negative equity position, and their debt hasn't necessarily increased by very much. At the same time, their revenue has continued to grow, recently hitting $22 billion. Now, when I made the video, I rated NEO as a sell. I thought the company was worth about half the revenue, which was about a share price of $2 to $3. So I would say that NEO completely blew away what I had expected for the company, and I would say that this was a missed opportunity. So my next video was a twofer on August 20th of 2020. I covered Apple Apple and Tesla right before the stock was about to split. I had expected Apple would continue to run up until about when the split would happen, and then I expected it should have a pretty good sell-off. I also found that companies that split their stock tend to outperform the market over the next year. So when I made the video, I saw Apple worth about 80 to 112 post-split, and by the end of 2021, I thought it would be worth about 94 to 132. Now, Apple stock has done really well over the last year. Right now, they're sitting just below $150 per share. At the time, I did recommend buying Apple, but it has definitely exceeded my expectations. When I look at the chart with my valuation in black below, it does seem like the stock price has bounced pretty strongly off the trend line that I had decided on a full year ago. Now, Tesla had a really low trailing valuation at only $54 per share, but by the end of 2020, I expected $226 per share, and at the end of 2021, I expected Tesla will be worth $404 per share. Now, Tesla has also completely outperformed these expectations, and it really hasn't come close to what I thought the company would be worth since I made the video. Right now, they're trading at $714 per share, which is well above the $404 2021 valuation expectation that I had made last year. Now, I rated Apple and Tesla both as buys at the time, so if you followed that, you definitely did pretty well. However, both companies have far exceeded what I expected, so I would say they both outperformed. So after Apple and Tesla, I moved over to Ford. Ford stock had been falling for years, and I wanted to see if now was the time that Ford stock was finally going to turn around. They just switched CEOs, and the stock price seemed like it was finally starting to rebound. So doing my research for this video, it definitely changed my perception around Ford at the time. And since I put the video out, it does seem like all of their products have continued to do pretty well. Now, I had used a price to sales ratio to value Ford at the time because they were struggling to produce a profit. Based off of the trailing revenue, I thought they were worth between $8.80 per share and $12.81. Looking ahead to 2021, I saw a forward valuation between $9.55 to $13.47 for the top end number. On this chart, it shows Ford's stock price since I released the video, and you can see Ford has pretty much remained close to the top end number that I used for my valuation. So I would say that Ford has performed about what I had expected at the time, so I would say that my valuation was accurate. So the next video I did was on November 2nd of 2020 on one of my favorite companies, AMD. I did this video right after AMD had announced they were going to buy Xilinx, and at the time I saw AMD worth a trailing valuation between $41 to $63 per share. Now, AMD has done pretty well since I made that video. They've gone from a share price of $75 at the time to recently spiking to an all-time high of $112 per share. When I made the video, I expected by the end of 2021, AMD would be worth $105. Based off of that, AMD has slightly outperformed what I expected, but I would say it was close enough to say that my valuation was accurate. Now, I did make another video on AMD recently that updates what I think about the company and my valuation all the way out to 2023. So if you're interested, make sure you check out that video. Moving on to Microsoft, which I covered on November 16th of 2020, I projected a trailing valuation of $217 per share. I thought by the end of 2021 it would be worth $237, and at the end of 2022 I saw $216 for their value. I saw the new CEO really turning around the company, revamping their image from that old, stiff, and boring, and slightly incompetent Steve Ballmer-led Microsoft. Now, Microsoft has outperformed what I expected the company to be worth. At the time, I didn't see Microsoft's value reflecting today's share price until sometime after 2023. Microsoft has definitely risen much faster than the valuation that I expected for them, and what's happened is they've blown away the analyst earnings expectation that I used for my valuation. I thought they were worth a PE of about 35 at the time, and today Microsoft currently trades at a PE of 36, so I was very close here. But since the share price well exceeded what I expected, I would rate this as an outperform. Now, the eighth and the last video that I'll cover in this video was Netflix. I released this video on November 23rd of 2020. At the time, I remember having some concerns about them because I thought they were going to struggle with growth going forward, and I thought there was only so much that they could raise their prices to grow their revenue. I used a growth rate of 15 for Netflix, which gave them a fair PE value of 38. This meant their trailing earnings valuation was $235 at the time, and by the end of 2021, I expected $343. Now, Netflix has way outperformed my expectations, basically remaining between $475 to $575. The current price to earnings is 54 for Netflix, so it's definitely much higher than I thought that the company was worth. I would rate this as a missed opportunity, but if I'm being perfectly honest, I still really think the price is way too high, and it's still not something that I'm interested in buying. I think that I missed out on the cruise lines, Neo, and Netflix. and Tesla, Apple, and Microsoft all exceeded what I expected for them. So it does seem like all the stocks that I covered, I was either pretty accurate or I underestimated where the stock ended up going. And I'm okay with this. This is kind of the goal with evaluations. Missing an opportunity on a stock or a stock doing much better than you expect is completely fine when it comes to investing. The real goal is to make sure you don't lose money or have a stock completely underperform what you expect for them. Okay, so that's part 1 of this. If you guys like seeing how my valuations panned out, make sure you hit the like button and let me know in the comments you want to see part 2. I do think that some of the companies that I covered after these first 8 videos were pretty interesting, so I do hope you guys want to see a part 2. My channel is still pretty small, so it does help me out a lot if you guys let me know what you're thinking in the comments. And as always, thanks for watching.